Yeah. So we'll jump in. So welcome everyone to Coffee and Conversation. This is a program that's being offered by the Cal Poly CIE Small Business Development Center in San Luis Obispo. And this morning, before I launch in some Zoom etiquette, we're asking everyone to mute their audio while our speaker is presenting. And there'll be plenty of opportunity for Q&A. And we actually welcome Q&A throughout the presentation. I'll be monitoring that and bringing questions to Elizabeth as we go through the program. So Elizabeth, so good to see you. Thank you for being here. And at the end of the program, we'll go through some slides where we'll highlight some of the programming that we have. Just as a reminder, we're one of 1,000 SBDCs in the nation. We are sponsored by the SBA. And basically what we do is provide business consulting services for all businesses, from pre-venture, before you've even actually launched your business itself, all the way through to larger scaling companies. We offer a lot of workshops and training events. Those are open to any business owner to learn more about different facets of developing your business. All of our services are no cost, except some training events. There's a minor cost involved, but for the most part, all the business consulting is absolutely free. We have an amazing team of consultants. We have 35 consultants on board that are available to meet with you one-on-one to help you with your business. So we just want to thank our sponsors, the SBA. We're funded by the SBA and California GoBiz, as well as we have another key sponsor. I'm going to listen to a very short video from Maynard Cooper, a law firm here in California that sponsors most of our Coffee and Conversation programming. So we'll just watch this quick video. Thank you. Oh, gonna launch. There we go.
Hi everyone, my name is Jamal Al-Haj and I'm a partner with Maynard Cooper & Gale in the firm's San Francisco office. Maynard Cooper is a full-service law firm of national reach with over 300 lawyers across 11 offices coast to coast. Our San Francisco practice focuses on advising emerging growth companies and venture capital firms, including with respect to equity management, financings, employment, and intellectual property matters. We are extremely proud to be a Founders Circle sponsor amongst an extraordinary circle of other dedicated philanthropists who recognize the immense value that Cal Poly's Center for Innovation and Entrepreneurship bring to the SLO community. We hope that each of you enjoys this upcoming training and workshop and are able to incorporate the knowledge and know-how that will be presented shortly to further help grow, develop, and accelerate your businesses.
Thank you to our sponsor, Maynard Cooper. And with no further ado, Elizabeth Jennings. Elizabeth, you manage a fund, the Swan Fund, that is focused on social impact-driven startups. And I'm going to let you give us a bit more background about who you are and the focus of the fund. And then we'll launch into some into your presentation and Q&A throughout. So Elizabeth, thank you so much for being here this morning. Welcome.
Thank you so much for having me, Judy. I'm so excited for this coffee and conversation. I'm looking forward to the questions, and I encourage everyone to screenshot things, take notes, send them over to Judy. And if we don't have time to answer them here today, find me on LinkedIn or shoot any of us an email, and I'm sure we'll be happy to hunt down an answer for you. So my background that I'm bringing to the table here is the basis for this discussion. With the Swan Impact Network, we actually have two funding vehicles. We are an angel network that's national. We're technically the fastest growing angel network focused on social impact in the nation, which is extremely exciting. And we also have an early stage impact fund that's technically a venture capital fund as well. The other hat that I wear is I run a consulting firm called Venture Atlas Labs, where we work with funds of all sizes, from those in Europe and private equity companies, mid-stage Series B venture capital funds, to those in Oceania and in Latin America to help them commercialize their portfolio companies in the US. So some of this content and the findings that I've been seeing since COVID hit are based on the angel network. They're based on what we've seen looking at other early stage deals and across the other spectrum of perspectives on what's happening and what the changes that have occurred from COVID as it continues here in the US. So I'm going to go ahead and share my screen so that we have the chance to see some nice, easy charts. And once again, please don't hesitate to send over some questions. I'm going to go ahead and jump right back in. So this is our wonderful logo. This is our wonderful content. Please feel free to look us up at swanimpact.org. There's a lot more information about what we see happening throughout angel networks in the US. We play well with many syndicates. We play well with other networks. And that means that we have pretty good insights around what's happening, not just on the truly social impact front, but also across other sectors where you have startups that are mission driven. Now, to clarify a little bit, if you aren't so familiar with what social impact means or what's qualified in that regard, it's any company that is mission driven to improve the world. And that's very simple. You could be selling socks, but if you're doing it in a model that improves humanity, that creates jobs, that treats people better, that perhaps they're recyclable or biodegradable, then you're a social impact company. So we fight very hard for health tech is one division and clean tech's the other. My job with the Swan Impact Network is to lead our health tech deals. So I'm usually looking at where we can get in on a deal, where we can help a company that's generally too risky. We don't know if the technology is going to work. We don't know if the market's going to accept it before venture capitalists with their Series A or their Series B come in. And in healthcare, if you're familiar with that, it's a very interesting place. Similarly with clean tech, because you're usually looking at very large, complex deals, but we also have portfolio companies in education and really across the spectrum. So I encourage you to take a look. There's a lot of great resources there about both the network and the upcoming fund. Now back to COVID and back to how this matters for you. This is one of my favorite quotes because it seems so salient all the time. When all of this started happening a year and a half ago, I stood up at our local medical school here in Texas. So we're based out of Austin. Swan's based out of Austin and Dallas, our headquarters. We are national and we do international investments. So I was down at our local medical school and I gave a talk about this weird virus we were seeing out of China. And the talk was about risk. You know, is this really a risk versus, you know, is it not anything? Is it going to have an impact? How do you consider these things if you're looking at supply chain? And I compared it to the flu because we know how the flu impacts businesses. We know seasonality. We know what the impact to labor costs will be because of that. But COVID, we had no idea. And I certainly had no idea what was going to unfold in the following months. What happened was that we rapidly saw investors across the spectrum have to triage their companies. Some investors said, I'm not investing, I'm just going to sit tight and ride this out. And some said, you know what, we have to pour money in, we have to save these companies. There are many methodologies. Then all of a sudden, all of us went, I mean, everything was on fire to say, how can we save this company? How do we choose where to pour in resources? Where do we reinvest? How do we make this work financially? Who do we cannibalize? And we poured all of our math at it. And then I saw humanity, because investors of large funds, of small funds, private investors, those running family offices, everyone made emotional decisions around, you know, but I can't abandon this entrepreneur. I have such a good relationship with them, or I really believe in this company. I know the math looks worse than this other company B, but I believe in them. I want to stick with this. This is relevant to me personally. I'm going to do it anyway. So the decision-making has really changed in a way that shows you how investors truly think across the spectrum. Now, as this whole COVID situation has matured, we've seen a ripple effect across the way investments are analyzed and considered. And that's what I want to spend time chatting with you today. So I'm going to go through this pretty fast, but once again, please drop questions and take notes, because this is truly the most salient points, the most meaningful points I could find that will help you move your company forward. So here's what's happening. If you were selling to a customer or to a new client, you're doing market research and you're trying to figure out what are they thinking? How are they buying this product? How are they incorporating this service? How does it affect their business? The same thing you need to know when you look at angel investors or early stage investment. What are they thinking? Is this affecting their portfolio? How are they sourcing new companies? And you may think, well, COVID has probably made a lot of investors sit tight on their money. And that has happened to some degree, but by and large, it is setting records. Anything, if you Google, hey, is angel investment up in the US in this sector or that sector, or by quantity or quality, moving towards the exits, everything you will see is that we are growing exponentially here in the US and more or less in most countries that you would expect in Europe as well. If you look to the right, you'll see that the 2021 outline, now this is only for the first half of this year, and we're almost outpacing 2020 as well. And that's not because 2020 slowed down. And this is across all sectors that you're looking at. Similarly, the deal sizes are getting bigger. Now, this may or may not be a good thing for you, which I will discuss, but investors are increasingly willing to write larger checks for earlier stage companies. That's the key takeaway. And this has been a trend that we've seen as well. So this is our financial slide for the Swan Impact Network at large over these years. And you can see that we more or less find the same trend. We invested in less companies in 2020, but interestingly enough, we had less companies apply. So even though we're the fastest growing angel network in social impact in the US, in terms of numbers of investors, we had less companies thinking they were going to be able to fundraise. And part of that, which I will go into, is that when that happened, COVID happened, all of the leverage, because there's so much triage, everyone was looking at how to keep their businesses afloat and how this would affect them, so much triage that the balance of favor swung in favor for investors. So we saw a lot less applicants thinking they were really going to be able to fundraise last year, but it certainly wasn't for our appetite or for the appetite that I've seen across other early stage investors. So what you're going to find if you're looking to start fundraising, you're thinking, maybe we're going to do it in 3 or 4 months or maybe over a year, start having some of these conversations and spiraling up your finances, your pitches, and getting ready for this. It's a very quickly growing activity right now. That's not saying that you'll be able to fundraise quicker, but you may be able to get in front of more investors easier for this appetite. And I'll get into a reason why in just a moment. Then you could.
Elizabeth,
yes.
Can I ask you a quick question?
Of course.
So I have 2 questions. So did you see, so there were less deals in 2020, but bigger dollar amounts were being invested. Did you see the quality of the startups? Was it a higher level of quality that you were seeing in the startups that you were investing in?
I don't think so. Honestly, I think they were just the brave ones.
Okay.
I've seen in general over the last 5 years or so a general quality uptick in startups being better educated and better prepared for creating an investment narrative or having a stronger product market fit, stronger validation, more de-risking factors that they're aware of and have outlined in advance of engaging investment. I've definitely seen that increase. But over 2020, these were companies that were just hell or high water going to fundraise.
That's interesting. And do you think they were better prepared because are they participating in programs such as accelerator programs, incubator programs? Is that what is helping support them and helping them be a better fit with investors?
I certainly think so. So I've seen several things. Now, again, we're based in Austin. So Austin 5 years ago was a very different place. 10 years ago was a very different place. We have an incredible growth delta at the moment. So we have more resources every year than we did beforehand. But looking at national companies, I've seen at least going through one accelerator or taking advantage of SBDCs or other resources has certainly increased. And I've also seen an increase over the last decade in more senior level executives being involved in these companies, being involved in startups that maybe have other experience from corporate engagements or have already had other businesses themselves. I think there's
That's really interesting. That really supports, we feel very strongly about supporting our startups in setting up their advisory boards. And that is a way to bring in those experts and those seasoned, more seasoned entrepreneurs into the mix, who more often than not, end up joining the company in some fashion. But that's interesting. Yeah, thank you.
Yeah, absolutely. And these trends, I think, is very important to mention. Most of this was already underway before COVID hit. COVID just changed the landscape slightly and accelerated some of these trends. So some of this, one thing that happened, some of this is really predicated, and this is the most salient one, the landscape shift. So if you look at consumer behavior that's changed, you look at transportation has changed, work from home has changed, telemedicine has changed. So many things have happened, both from COVID, from the new administration of what we believe may be federal priorities. If you're looking at clean tech, so many new landscape shifts have happened over the last year, particularly the last year and a half. That new opportunities mean that incumbents are going to be slow. The multinational corporations that you may think own the market, most of them grow through acquisition of startups. They put the R&D risk on other companies. And that means that you have an opportunity to either exit quicker, get acquired quicker, build partnerships quicker, or move the market in a way where previously you didn't have as quick shifting opportunities that you are more nimbly able to take advantage of. And that gets early stage investors excited. They like to see something happen. They like to see change that they can take advantage of. In the beginning, it was very difficult for many, particularly on the VC side, because we had mandates to visit in person other facilities of someone who might be manufacturing something or the organization themselves in person. And a lot of this had to be rewritten. Not all of it has been. So due diligence in general slowed down for investors who are not prepared to do due diligence remotely. Now, fortunately with Swan, we've been largely remote from the beginning, which is one reason why we can grow so quickly across the nation, working in different areas. And for the most part, early stage investors have figured out how we can adapt, and that's certainly helped. One thing that we just mentioned, Judy, of course, is the talent from corporations. So we certainly have seen a longer trend of senior executives being more willing to work in startups, which to them is just a high risk environment. But investors love this. So they are coming more on board, and especially with the ability to work remotely, with better incentives, with larger funding raises, they're able to afford more senior executives. And that has encouraged more angel investors to join this realm of investment stage.
Yeah, I think, Elizabeth, to your point, I think that the senior executives being involved is another de-risking factor, right? So it helps in that regard. I do have a question that popped up in the Q&A, if I can just jump in with that. This is from Johnny White, co-founder of one of our incubating startups called Trees. He's asking whether or not, how early is too early for angel funding with your network with Swan? So I know the answer I usually give is traction is the decisive factor. And as we discussed, it can be traction through your advisory board or your executive team. It can be traction through pilot programs, but there's so many other facets. Do you want to talk to that?
Absolutely. Thank you for the question, Johnny. This is one of my favorite questions. So what you may find is true in one angel network is maybe not true on the other. And same thing, there are all kinds of investors because there are all kinds of humans. So some things I believe is true from my experience that maybe there's an investor out there who thinks that it's absolute garbage. So take everything you ever hear with a grain of salt. But here's my thought on this. There are angel networks like Swan out there that will never take a fee from you. They're not going to take a success fee. So we don't want to take your money. We want to give you money so that you're successful. So eventually we have a return on our investment. Other angel networks charge a fee. It could be pretty hefty just to apply. Sometimes they charge a success fee if they do fund you just for the administrative process, because it's very administratively taxing to actually go through full due diligence and all this. And every network out there and every early stage investment fund as well have processes for this. So it really depends. If you're willing, for some networks, you have a couple $100 and some time, then maybe you kind of want to play that accordingly. But for Swan, because that's just not the way that we work, we want you to invest, but we want you to apply. And when you do so, you may say, these are our 3 risks. This is, the core thing that we're looking at. This is why we need your money. And don't tell us, there are no risks. We want to win on risks, which is something that hopefully we'll have time to chat about later in this conversation. But tell us, this is early stage. These are our ideas. We have a little bit of traction here. We're really looking at, Swan Impact Network for the connections that you have in these areas. We see that you have a couple similar portfolio companies. And we'd really like your time and your energy in addition to just your seed dollars, for instance. And of course, that may vary. Maybe you don't want that. But sometimes telling a compelling story around that, even if we don't fund you, you'll get feedback on what your pitch deck was like, on your general presentation. And you may come back and apply again in 6 months and say, hey, we really took your feedback to heart. We still feel like we need these resources from you. Here's why it's a great time. Here's why we're doing something no one else could do. You really want to work with me, and we'd love to talk again. And you kind of set data points of, look at my trajectory. So honestly, if you can just start getting feedback from investors, it doesn't actually cost you anything. You always have to take that with a grain of salt, because some of them are wrong and they're never going to be your investors. They're never going to be your champions. But it's really good to learn how to handle those objections, how to present those risks as things that you can overcome, and just to get comfortable with the entire process. Because honestly, even though the stage is really set for doing positive work with fundraising right now, it's not, the resistance that you might have seen 2 years ago is not there right now. You may still be fundraising for a long time. So the sooner you can get more feedback and get better prepared for it, absolutely. One last caveat on that. If there are top tier investors that would be fantastic resource partners for you as well, that certainly have additionality and contacts and partners that may be particularly apt for your business, I might save those for a couple conversations down the road, because you may have many investors on your cap table, and you probably want to be really confident in your story and your traction by the time you speak with them, because if they're very sought after, you may be, competing with many organizations for their time. So, maybe start small as well. I hope that answers your question. Okay, so I'm going to jump back into this so that we can make some progress, but please keep the questions coming. And so my last point here is that there have been fantastic exit rates, especially here in the United States over the last couple of years, which means that investors have their money back to go play on a next investment. So what you're looking at, this is the result of it. You're going to have more competition, but the investors are also having more competition. And investors love to win. They love to win on risk. They want to find the one unicorn that everyone else thought was garbage, and they want to help make them successful. Investors love investing. They love this world. They love knowing what may happen. They like knowing industry nuances. They are very well educated people who want to champion entrepreneurs. Believe it or not, Shark Tank is not reality, especially in early stage investing. All of this leverage comes back and forth. And right now, currently, there's a lot of optimism towards how the economy is going to go in the US. There's a lot more optimism than there was a year ago. And so right now, because investors are having increased competition at the early stage, you will have more leverage. It means they're willing to invest earlier on. They're willing to invest more dollars. And their willingness to go the extra mile and help train you with business conversations with potential partners, for instance, has increased. Okay, do we have another question, or do you want to jump on?
We're still good, Elizabeth. Thank you.
Okay, excellent. Okay, so here's the most salient advice that I can possibly offer, condensed into a couple of bullet points. If this is your first time fundraising, please think about how in your investment narrative. We see a lot of product pitches and a lot of them are amazing, but the product's not the problem. The technology is not the problem. We believe you, more or less usually, that you're going to be able to accomplish the new technology that you say you are. That's usually not where it fails. Where it fails is in your product market fit, in understanding your customer strategy and understanding how you're going to get there. And that's where your risk is. So if you're thinking about this from the investment mindset, you're looking at trying to figure out, can this company not just win on product, but also win on market? Because figuring out that product market fit is exactly where I'm putting my money into this company. So all of the risk is right when I'm investing. And that's the way the thought is, that's where the due diligence comes into play is, okay, we have all of these upfront risks that every startup must have, that every small business must have, because you're trying to change something. You're either disrupting the market, you're outplacing competitors, you are moving someone's workflow over, you may be changing huge things or small things, but you're affecting the market in some way. And all of that means that you need to have a strategic approach to winning on those risks. And that means we want to know how you make decisions. Don't just tell us, the market's this big, we're going to be 5 million after 5 years. And we ordered our market approach towards the biggest segment, and the second biggest segment, and then so on, because that's not a strategic plan, that's math. We want to know how you're making decisions based on your value propositions, based on where you fit pricing, based on if you see copycats coming up. We want to see your thinking around this. I'll talk a little bit more about that in a second. We want to know how you work with people. Do we want to deal with you for the next 5 years? Do you want to deal with us for the next 5 years? Are you going to be a gregarious CEO? Are you a compassionate founder? Are you aligned with the same values that we have? This is very important, and how you fit in their portfolio. This is very, very important, especially if you're looking at angels. If you're looking at an early stage VC fund, that's a different situation because you'll probably be able to figure out the components of their portfolio structure. If you align with their thesis, if you are the same cultural vibe that they may be looking for. But for an angel, it's very personal because they definitely want to make their money back. They have their own skin in the game. And it may be a little bit more opaque about what kind of companies they personally invest in. Okay, so a couple of guidelines on this, just these 4, and we'll jump in very quickly. Risk aversion is less relevant when you show your work, which is the sum of most of this. You may think, oh, but I'm in healthcare or I'm in clean tech, or they just don't understand. I haven't really gotten the narrative down right because they don't quite see how this can be real. That's risk aversion in several capacities. They love to win on risk. All of us love to see something that they can help turn around. Most investors believe, and this is generally true, that their experience, that their education, that their witty insights will be the thing that help you win, not just their money. Most of them don't want to be passive. So they want to see, we may not beat this competitor, but here's why I think we can. So when they're looking at those multiples, they think, I may get 3 times my money back, or 10 times my money back, or 20 times my money back. How likely is that to happen? It's that risk factor of your product market fit. It's very important to think about how they're looking at risk so that you know how to go through it. Okay, I'm going to skip through this because unfortunately I don't think it'll work well for our features. But if you were to play 2 lies and a truth, it's always the truth is the failure's product market fit. When you go through due diligence and you're looking at a company, we really dive into how are they going to acquire customers or clients? How are we going to get new revenue streams? Do we need to break this down into a different type of pricing scheme? There's a lot of emphasis, not just with the Swan Impact Network, but across the angel networks that I've worked with in figuring out how likely these things are. It's all based on your decision-making criteria for figuring that out, especially if you have, let's say, 5-year period before you're really going to be revenue positive. Your technology may be brilliant. You may have an MD and a PhD and have an incredible advisory board, but no matter what, you're going to be, running in the red for that period. And that can be very, very challenging. So the key here is to have decision-making criteria. You have your market research that's applied to sales, that's applied to revenue, that takes into account other major market drivers and how you're going to be able to pivot. We can go into different methodologies of thinking through those thought processes, but I highly recommend that you bring your counsel in, your advisory board, your 3 mentors that you have in your pocket, and say, how are we going, if this happens, how are we going to handle it? Because then when you have a conversation like this with your investors, let's say you have a great pitch, for instance, and you get to the Q&A and one of them says, yeah, but, I hear this big company's doing this also. Aren't they have so much more resources. They can afford to just, let this bleed for as long as it needs to. They can bring in international partners as well. They're just going to beat you in the market across the board. But let's say you see something they don't. You know how the budget structures work, and you're going to be able to spearhead in completely different products because you actually have a better sales pattern because of the way your technology works. You have investigated this, maybe you come from it. You don't tell the investor that they're wrong. Say, no, we know they're doing this, and it's very interesting. And that's why, we have looked at it this way. Now, if we're wrong, and something changes, here's how we're going to address that. We're going to come back with this partner over here that we've spoken with. We know we can add on this feature, or we can subtract this and change our pricing scheme. We have that ready to go should these things happen. And here's how we look at it. That takes the investors out of the fear mindset of what's the unknown. How are we going to address this? How are we going to triage this company to, okay, well, we actually have some nimble strategy here. And it takes them in a totally different mindset. They start going out in the playbook. And that's how you get engagement in that. You take them completely out of the risk mindset and start talking about how you're going to make decisions together. It's, I promise, a totally different conversation. When you're looking at this, especially if you've never been through the due diligence process before, and some of them with different investment funds, particularly on the VC side, can be very opaque. We're going through what those risks are and how they're going to kill you. Because the LP that brings that to the table, or the angel investor that invites you to apply, will have to come back and say, okay, I'm sorry, guys, they're absolute fools. I apologize. Or they're going to have to champion you. And for that, they're going to go through all of these risks, all of these reasons why something may not be as true as we thought it was, and figure it out. And we reverse engineer that. So if you're going to have a pre-mortem instead of a post-mortem, think through this yourself of, oh, okay, my company's going to fail because we just couldn't get enough operating capital. Or each of these items, you can walk through this on customer acquisition. Our cadence is too slow. We need to find a way to acquire more companies of this size or acquire more sales. We can look at our profit margin maybe. Walk through how each of these milestones may work. And I know this sounds tedious, but bring in your leadership team, that council I mentioned, and just guesstimate, use Fermi estimation. So just make it up with what you think. And the more people you include on this, the more correct you're likely to be. It's an interesting phenomenon. I encourage you to Google that. But assign weight to this. So we think that our market strategy may be a little bit weak. We're not entirely sure if this will work. We see a lot of investment in telemedicine, for instance, but we know hospitals have no money right now. Or we see consumers thinking about these things, but there are so many incumbents. We're not entirely sure about this, because the point of this isn't necessarily to be right. It's to walk through how these risks are considered and how they affect each other. Ultimately, if you found 10 different stages of things you must be able to accomplish to get to your next milestone, if you're looking at seed funding and you need to get to Series A, and you plan your forecast is going to be 5 million of revenue by the time you get there, you may find all 10 of those things and think that you have 95% of a chance, with your counsel of beating each of those. You still just have a 35% probability of actually accomplishing all 10 of those risks. And so that's how investors may look at this. And again, asterisk, Many investors will fall in love with your story. They may have personal connections to it, particularly angel investors, and they may not be rational at the end of the day. They may just believe in you. But the further you grow, it's very important for your partners to see that you understand how you're going to stay in business long enough to continue to support them. And especially as you build a story that will carry on with Series A and Series B investors. If I took this away with what I'm selling still exists, I highly recommend Rework by Jason Fried. It's a great book to help you think through the areas in which you have a lot of risk as an early stage business, of evaluating, can we be more nimble? Should we go all in these areas? Think about that. If your entire narrative is predicated on your ability to sell this to doctors or to tire salesmen, or to revolutionize the way that people get in their cars, for instance. But if that's not true, what happens? And that's the way you'll have a much better conversation, much better foundation for a conversation when you start engaging investors. How you make decisions, you have that decision tree of, okay, so maybe our channel strategy shouldn't look like this, or maybe it'll work, we'll test it. Maybe we should have more old-fashioned conversations and start calling up our network. Maybe that's not scalable. And write all of these things down, back of napkin with your team, and make sure you have people while you're doing this process in the room who do not agree with you all the time. There's an old saying that if you have two people in the room all the time who agree with you always, one of them's unnecessary. So bring in people who may be a little more challenging, who maybe don't have the exact same perspective you have, because they will find the places that investors are also likely to say, yeah, but I just don't believe you. Of course, they may be wrong, but you want to learn how to say, this is still why we're going to make this decision as objectively as possible. Because again, you take them out of that risk mindset and more into the decision-making mindset. Run this pre-mortem as much as you can. Anytime you can, go into a pitch with investors, into a new conversation with potential partners or potential customers, have someone else in the room from your team whose job it is to listen to how that meeting goes. I can't emphasize that enough. When you're speaking and you're handling the actual transaction, when you're giving the pitch, you are in pitch mode, you are in speaking mode, you are not in listening mode nearly as much as you think you are. But that other person can figure out who's making the objections, how they're making them. Are they taking notes? What are they kind of writing down? Where are they writing items down? When do they just go silent on you? When do they do the investor retch where they lean back and they're ready? Oh, they're ready to just chomp at the bit. Those are very important things to get a cadence for. That person's job is to prepare you, maybe throw you a couple of softballs, maybe interject when they need to. But they're your wingmen for figuring out, is this pre-mortem going to hold water? Did handling that decision-making criteria or showing that risk objection in a new way actually help the conversation? And again, this could work with both investors and with partners, but figure out how you should do this, what your protocol should be, how this affects your commercialization strategy or go-to-market strategy. Should you change a couple of features? Because every time you give a demo, it's that one feature that just drives everyone nuts. Maybe it's worth refining and running that pre-mortem where those risk areas are as you go out in the world will make a much bigger difference. Okay, last salient point here, then maybe we'll have some questions. If you do not have early stage traction, if you have a very long cycle to get to market, if you're in healthcare or cleantech or some fintech, if you're not selling direct to consumers, but you need money up front, you need that operating capital, you need R&D money, sell something to someone who can. Maybe you have training data. Maybe there are other services you can sell. You may have to think of a direct to consumer product that's a lighter version of your wearable, for instance, or something that you could sell to allies through the military that doesn't have to be FDA approved. You could sell something to other countries that have great trading relationships with the US. If it's going to take you a long time, don't keep running up against that wall of hoping that you're going to get a huge investment chunk up front, if it's not working for you, maybe think about carving some of this validation out and phasing it in a little bit easier. And again, this may not be applicable to you, but if you do have an incredibly long sales cycle with a lot of upfront capital needs, this will go a long way to showing there are other organizations that also believe in me. We can see how this works, and we know what our next step is. Phases are fantastic for early stage investors.
On that note, Elizabeth, can I ask you a quick question?
Absolutely.
Do you have any specific example of a company that the fund invested in where there was no revenue whatsoever? It was a pretty long-term cycle that if it was to happen, it would have been long-term, where just basically examples of this easing in market validation piece that you just touched on, something compelling that would inspire some of the founders that are on the call today.
Absolutely. So that's worked out very well for my next slide.
Okay.
Perfect timing, Judy. So this is what we see almost always in healthcare, because you're looking at 5 years or 7 years, or sometimes even further, to actually get a biotech product, a pharmaceutical, a medical device, a diagnostic. These things take a lot of upfront capital. So especially in those cases, but sometimes there's other organizations that you may have products that just take a long time to be able to develop. Scientific products, especially in energy, we have one company that's a New Zealand wool company where they have a special breed of sheep, and they made air filters that are now in space because they are anti-inflammatory. And this is amazing because it took them 12 years to breed sheep. So if you're investors, you think about that, like, wow, okay, we're not, inventing a new therapeutic, but this is going to take a long time. It takes a lot of faith. So here's a simpler example. Lazarus 3D has done fantastic in 3D printing replicas of specific organs within the body, and this may be a little bit gross, for a specific patient. So everyone's body looks different. So let's say we're having brain surgery. Knowing exactly how your brain is structured with a specific tumor or a specific lobe in the place where we have to get around this because it's deformed for another reason. This is very important. And because it was going to take them so long to actually get to market, they sold their research products of figuring out how to scan the organs to universities. They've shown this to diagnostic companies, and they are primarily funded through actual revenue partners of these organizations, because they also need to know how to scan the body more effectively. So they took an earlier technology and they started building in revenue streams with that. You may also see corporate venture partners are fantastic for this. They want you to have all of the risk. They're willing to invest in you while you have all of the risk of figuring out how these work. So you may have organizations like 3M. If you're in adhesives or medical products like filters, masks, that sort of thing, you may have really any of the big companies you will find have these venture arms where they have partnership programs. They may invest in you while you develop something for shared IP, for licensing rights, for distribution rights. You come to that early on and you can sell them some of your information you come along, or a specific product you make in partnership with them. And that may cost you 3 years of development, which you would be in anyways, but you typically get resources from the organization, such as employees, to help you as well. So it can be a very favorable agreement for you. In other terms, we had a company that had an oxygen sensing wearable, and it was fantastic. It was more effective than Apple Watch, for instance, and discovered that the primary use for this could be for pilots who may be losing oxygen in their cockpit. And this is all very tragic and delicate, but the short form was that it was very difficult to find pilots who wanted to wear this wearable that would alarm them if they're having issues. There were other pieces in place as well in these aircraft, and had to pivot to selling the wearable inside socks for long-term living facilities, because they could sell these direct to the consumer, or people who were caregivers for Alzheimer's patients, or those who may be otherwise experiencing discomfort wearing lots of wearables around their wrists or other tags around their neck. And they usually wear socks. And there were other also opportunities where they could just scale that way. And that way they got more training data. They got more in-market validation to say, this is how we're collecting information. This is how we're seeing it work. We didn't really intend to be in this market, but now we have some consumer data before we can figure out how to sell with the military. So there are many different examples like this, but sometimes you have to hunt around to figure out which experiment will really work to start bringing in that early revenue. Have lots and lots of conversations with people who you believe are in your target market and several who you believe aren't. That's the best advice I can have. It's just many, many conversations around what their needs are and how they're going about solving those needs.
You know, I just want to put it out there to anyone who's listening in. If someone is early stage and is trying to figure out how they can get that early traction validation piece in place, if they want to actually share an example of their product or service, you know, now would be a great time to do that. It's just, okay, we'll see. We'll see if the Q&As come in. Thanks, Elizabeth.
Absolutely. There are so many examples of this, but I highly recommend finding a way if you're having trouble fundraising. Okay, so I'm going to go through some of these very quickly because I want to make sure we have more time for the conversation part. Please stop pitching your product when you're speaking to investors blindly. We want to know about your product, but a product pitch is very different than an investment narrative. An investment narrative talks about the business portion, and especially if you are in the sciences, we love this. I can't tell you how much I appreciate new healthcare innovations, new life science innovations. That's what I wake up early in the morning for every day. But we have to understand, how is this going to be commercial reality? Because that's how you keep making money, to keep developing life-saving technologies, world-breaking technologies, world-changing technologies. And that's how we get our money back to go do another investment. So figure out who's going to buy this. How stable is this assumption? Are we going to be able to go straight to hospitals? Are we going to be able to sell this into one specific type of corporate buyer, for instance? Is there a lengthy procurement play here? Are there other partners that broker these relationships? What's driving down prices, for instance? Are there bundled interdepartmental contracts where there are incumbents that are selling in multiple product types across departments at odd cadences in this contract just to keep out everyone else? Because I assure you, there are some remarkable pricing strategies out there and contracting strategies to try to keep market stability for companies. Knowing how to talk about that and knowing really how you're going to execute, how you're going to be a good steward of this early stage money to get through that de-risking area of figuring out how you win on market is all of this. How are we going to make money on this company is how you're going to make money on your company, right? So if you may have a projection slide at the end saying, here are some other exits that happened for other companies, knowing a little bit more about how that actually happened. If you plan on partnering with a corporate venture fund, for instance, that's excellent. And talking more about, we are really targeting these 3 corporate ventures because we want to be acquired by them. We believe that would put us in a great market position. Our executive team plans to stay on board after acquisition. You know, this sort of thinking really helps, even if it doesn't entirely come to fruition 5 or 6 years in the future. And figuring out how to tell a story that this is going to be the company when all of their other portfolio companies fail. You're going to be the one, you're the investment that's going to bring all of the money back. And again, that may not be the truth, but you're going to do your very best to make sure that it is, with the information that you have, with the resources that you have, to be a good steward of that money and to help them move through that risk and win on it. I highly encourage you to think through this. And I'm going to go ahead and skip this because I think we have other things to talk about, a couple other case studies. Show up wisely. This is so important. Same thing if you're looking for finding product market fit with clients or with customers. you need to find your advocate, because many times you have stakeholders who will champion you up. You have someone who may not have purchasing power in the organization, but they may be heavily influenced by, one of their senior advisors, one of their managers, that even though they may have a higher title, they listen to them. And then figuring out who you need to be targeting may be counterintuitive, particularly with early stage funds. You have lead scouts, you have many analysts in VC funds, you have partners that they work with, such as accelerators, and they are always saying, this startup's really hot, we really like them, this person has perseverance, this organization's really resilient. We've seen them come in every day when it was pouring rain and their dog died and it was terrible, and they figured out how to change a story when 3 of their customers hated their product or whatever it was. Those things mean a lot in this world. And finding that advocate is so important. I guarantee you, if you have an angel investor who believes in you, who puts their own money in, and they bring you into an early stage fund, or they bring you into a network, the conversations that you're not going to have visibility to will be that person trying to make other investors believe in you the way they do. And so finding those advocates and empowering them, this is the story, this is our decision-making criteria, we are partners for a long term for you, really goes a long way, rather than just putting it blindly out there and hoping someone resonates with it. Specialist VCs and specialists in general can be very powerful. There are many broad funds that have, if you're going to take Sequoia, for instance, who will have specialists within who try to do everything for everyone. But there are also smaller VCs that are early stage that focus exactly on what you want. And the reason why this is so important, honestly, is they will understand more of your risks. They may understand your risks better than you do because they've been doing it for the last 20 years. And they've seen those drivers change. They may have helped affect some of those drivers to change the marketplace themselves. And they will put skin in the game. They will put resources, they will put manpower, they will put connections from the Rolodex behind knowing how to get through those riskier areas specific to your industry. Go deep. If you can't delegate out your weaknesses, find a way to just improve your strengths. Your specialist VCs do not want you to be broad. They want you to be very deep and very strong on exactly what you're doing. When you talk about visibility, getting more visibility in front of investors, you may spend a lot of time on pitch competitions and you may win $5,000 or 10 grand or 20 grand. You may go through accelerators like you're collecting park badges or something. And those can be really great, but please be strategic about this, because you have, as founders, as CEOs, as those people who are championing key functions in early stage organizations who are already stretched so thin. You have little time with your families, little time at home. Well, maybe COVID's helped with that. But you are already so key and intrinsic to the success of these companies. Please be strategic about building relationships early on, telling that story. Even if you aren't pitching an angel network or pitching an investor, you can build a relationship with them and say, hey, you know what, we're working on something. I'd love to follow your work and your thoughts on LinkedIn. I'd love to follow you on Twitter. I'm going to come back to you in 6 months or a year when I have a story to tell. Right now, we're doing our homework. And I guarantee you that is perfectly fine. They will love to hear that. But look at really who may be your strategic partners outside of your geographies. This is a very well interconnected world we're living in, especially now with everything being more remote. And look for those who really may have the additionality to help you go further.
Elizabeth, sorry, we have a great question in the Q&A. Can you hear me okay?
Yes.
So this is from Carrie. This is a really good question. She is going under the assumption, she's saying, I'm guessing that social impact investing generally has a lower exit potential than traditional high-tech investing. And can you talk about what kind of returns you expect to see a company pitch for, if it's to be considered for your portfolio? What's too small? What's not worth your while? Do you really push your companies towards aggressive growth? Great question, Carrie. Thank you so much. Elizabeth.
Yes, this is a fantastic question. So I wish I had a slide on this, because I swear I have a slide on this that's brilliant. But believe it or not, social impact companies tend to outperform the S&P. They generally outperform many categories of investments. And that's it's such a myth, because you think that if you're doing good, you can't also make money. And that just doesn't seem to work. I think personally, this is my own personal hypothesis, the founders are more committed. And if you're mission driven, you have a vision that you're going to stick to, even if you have to phase things, even if you have to pivot, you are compelled. And I think that that matters. I think there's a lot of resilience and determination that ultimately go into figuring things out when they have not been figured out by anyone before. And I think those companies have a better chance of actually succeeding and changing things in the world and in the market. So I wouldn't say that they underperform in general. And I certainly wouldn't say that social impact funding is then close to philanthropy. Some angel investors may joke, because certainly you're not an angel investor because you're just looking to get rich. If you're an angel investor, you're doing this because you believe in these companies, because you enjoy engaging with them. If you wanted to make lots of money, you would go off and do other things. And most of these angel investors already have. If you're in impact investing, you really do want to make a difference. So it's not just about the return. There's a completely different world of impact measurement, which is something that could be easily Googled. And I highly recommend, if you are a social impact company, that you look into impact measurements and how we gauge how you affect your society, your community around you, how you treat your employees, the ESG measurements, for instance. But there are many different ways of evaluating the actual impact of the company, more than you would just look at, for instance, an AI company. Now, are social impact companies always going to outperform, hashtag blockchain or hashtag AI or any of those other buzzword categories? Probably not, but I certainly wouldn't say that we expect a lower rate of return because of that. I think with Swan, where we currently are at the moment, we probably have about even splits between health tech and clean tech. And that means we're looking at big companies with big potential returns. Most of those are they really may be $50 million returns. And most of them may be underneath 7 years. So with angel networks and early stage investing, you're usually looking at getting your return within 7 years. Somewhere between 4 and 7 is typically what we would expect. But we don't necessarily, we wouldn't consider it disappointing if we just get our money back, because we care about the investment as it matters. We care about the impact. We care about being engaged with the company. So there are more things that come into play than just money.
Thank you, Elizabeth. And so I'm so sorry, we're coming to the end of the hour. So but we'd love to see the rest of your slides. Is there many to go through, or?
I knew there was going to be. Okay, so last point. This is so important.
Yes, thank you.
You will expect it a lot, because these are humans. They may have a bee in their bonnet about something, and they may just be wrong. If you can learn how to show your decision making, you can be rational, you can be calm, you can be a kind person that we want to work with, and your business totally fails. Let's say it's been 20 years. You can come back, and that investor may have moved on, and you will be welcomed with open arms. Don't burn your bridges. Continue to tell your story. Go on to your next venture. Maybe things change in 6 months. Maybe that investor stops it. And this is not about Swan. This is about everyone you will ever speak with. Some are going to resonate with your story and your mission, and some aren't. And you're going to get good advice and bad advice, and it's noisy and it's messy. Persevere through it. That is the best possible advice. Be flexible about how you go there. Look at your risks. Be very open and honest and objective, because we want to see you succeed, not just to get our money back on it. We are in this world so that we can help make things happen. And we believe in paying things forward. We believe at making a more level playing field for everyone. We want to see these things realized. And we know sometimes it's completely unfair and irrational and messy. Be flexible, but don't stop. You can always take pauses and take care of yourself, but be open, honest with your investors, with your team, and be flexible about how you get there, because you will get there. And none of us would be in this if we didn't think so.
Elizabeth, I love that you ended on that note. When I'm asked, what's the key factor in determining the success of an entrepreneur, I think perseverance is definitely the magic word. Yeah, I love that. Thank you.
It's a great environment to look for funds now. It's a great time to be fundraising. If you are, if you've been told your company's too risky or too early stage, there's really never been a better time than now to look for funds. That's absolutely true. And you may still have to build in some resilience. But I think that you'll be better for it. And this is speaking from a lot of experience and someone who goes through a lot of pitch decks. So please persevere. And if you are interested in quarterly funding, our next application deadline is Monday, October 4th. Feel free to reach out to me if you have questions. Again, you can find all the information and helpful guidelines on what we look for at swanimpact.org. And like I said, it's free. It's relatively painless, so you do need to know what you're doing, but it's not too painstaking. And you will get feedback on your application and on your pitch from our network.
Elizabeth, thank you so much. This was just an amazing presentation, really refreshing, lots of amazing tips, incredibly valuable. Thank you so much for being with us this morning.
Absolutely. Thank you for having me, Judy.
And just as we close up, we just have one slide to share with upcoming trainings, workshops, events coming up. So Madison is sharing the screen with us, and I'll just wrap up with that real quick. So we have our QuickBooks Intermediate workshop on August 26th from 1 to 4 with Damon. You can register on the link here. We can send it to you. You can send us an email and we'll send you the link directly. We have an awesome open house happening in North County that we're very excited about. We're expanding our program. We're launching our Ag Tech Incubator program out of the Sandbox in Paso Robles. We'll also be offering SBDC services up north. So when we do resume consulting in person, we'll have a location in North County. So for the businesses located in that region. But please join us for open house. The space is beautiful. It's been completely remodeled right in downtown Paso. It's a super cool co-working space. And our next Coffee and Conversation, September 8th, we are going to start hopefully offering a hybrid program. Well, we'll have an in-person option and a virtual option for those who want to just log in. We'll be hearing from our winner from AngelCon 2021, Tally4, an amazing startup. They obtained $145,000 in angel investment from Fund 4, from AngelCon Fund 4, and then also another $220,000 sidecar investment from investors in the fund. And they're actually raising another couple $1 million right now. They started, I think, a priced round of funding. So it'll be really interesting to see where they're at and how they're growing this year. Great company to keep an eye on. So join us in September as well. Thank you all for those who attended, and looking forward to hopefully seeing many of you in person next month. And Elizabeth, thanks again. Really appreciate you being here with us this morning.
Likewise, this was a great conversation.
Have a great day, everyone. Talk to you soon.